Hey guys, welcome back. I wanted to jump on here really quick and explain the difference between selling options and buying options. We're getting a lot of questions as to what the differences are. People seem to be a little bit confused, so I thought it might be advantageous for me just to make a quick little clip that explains some of the details. Okay, so I wanted to give you a little clarification on buying stock options versus selling stock options. So buying stock options, you're either buying a call or a put. You either want the price to go up if you're buying a call option, or you want the price to go down if you're buying a put option. If you are selling options, you want the opposite because you are the individual on the opposite side of that trade. So as a buyer, if you buy a put option, you want it to go down. If you sell a put option, you want it to go up or at least stay above your strike price. Now we could go into a ton more detail on this, but I wanted to keep this video relatively short. So what I'm going to do is I'm going to show you an example of selling options. I'm going to show you what type of trade I would actually execute on this stock. So Tesla's in an upward trend. I actually think it's going to continue to go up. It's a little bit volatile, so it's had some bounce backs. During the stock split, you had a nice run up here and it peaked at 502. And then you had a pullback because obviously this was overrun. You can see on the RSI that it's kind of spiked out. That's the relative strength index, meaning it was a little bit overbought. So it's dipped back down into the normal range and now it's working its way back up. I think this stock is going to continue to go up, so I'm going to trade a bullish trading strategy. Now, if I was buying options, I would be buying a call option, but what if I'm wrong? What if it goes down a little bit or stays neutral? In that case, I would lose the trade if I was the buyer. If I'm the seller, I can actually pick somewhere down in here to sell my option, and as long as it doesn't go below that on the expiration date, then I make the money. So where a buyer has to be completely right on the direction, the seller does not. Let me show you an example. We're in the options chain for Tesla. Let's go to the expiration date closest to 30 days out. This is at the money. This is where the current stock price is trading at 442. We're going to go much farther out of the money. We're going to come up here to where the probability out of the money column is over 85%, and this delta is well below 1.5. We're going to right click, sell a vertical. Now the bid-ask spread is a little bit high here. We would definitely need to back this down a few cents, but this is the 282-280 spread. Confirm. As you can see here, our profit is going to be $200, and what we're putting in to get that out is $1,800. 200 divided by 1,800 is an 11% ROI prior to commissions. Now the short strike price was 282. If we draw a line right at 282, you can see this line is well below the current strike price, and this trade expires in 28 days, and that's represented by this gray line here. So it's very simple. When you sell stock options, as long as Tesla is not below the yellow line by the time it hits the gray line, you make that $200. If it were to come down and hit the yellow line, that's when we get out of our trade. That's where we'll place our stop loss. But as long as it's even 1 cent above this line on the expiration, then we win the full amount of the trade. So as an option seller, I don't have to do anything here. I've now placed the trade and I just watch it every day to make sure it doesn't come hit my short strike price. As long as it doesn't, by the time it crosses the gray line, I make the full premium on the trade, and that flexibility is why we really love to sell stock options.